Kalispera Anthropos, welcome everybody to O Economica, all about economics and finance. Thanks a lot to all new subscribers, you're all very welcome, and if it's the first time that you're watching this video, please subscribe. I will provide you with free updates about the stock market and the global economy and everything in between. You're all very welcome, the content is free, so subscribe. So today we have the usual UK inflation data, and so far nothing new under the sun. Everything was pretty much as expected, and I will explain to you, we will see something very, very funny, and I'll explain to you why I'm saying what I'm about to say, so that the Bank of England, or the long-run average UK inflation rate, is pretty much more or less on target. So after I say this, you may say, oh my goodness, what are you talking about? There's a huge cost of living, and we see here that the CPI was 3.4% in December, core CPI was 3.2%, RPI, so the retail price index, went up again to 4.2%. What are you talking about? And that's actually very, very objective and true. So we are nowhere near the so-called 2% price stability target, which the Bank of England will never achieve, not for their fault, but what I said is that the long-run average inflation rate for what concerns the functioning of the UK economy, we are pretty much around that long-run average. And what I'm saying, it's very, very simple. So here, before I run my model update, okay, you can see with me what was the forecast that I had here. Okay, yeah, that's what I was looking for. Okay, so in October, I ran the ARIMA model forecast. So we ran the autoregressive integrated moving average of the CPI data, the monthly figure or CPI data, but they are measured year on year. Okay, not the month-on-month change, but year on year. So the inflation, the headline inflation every month compared to the month of the year before. Very simple. So the forecast that I got out from here, my modeling, was here. You can see 3.6. Okay, November and December, and there is a 95% CI confidence interval. So we have the lower bound data around 2.93%, the maximum upper bound 4.2%, and that is a range of confidence interval range. So if we see the inflation data here, we have the forecast on this website was 3.1, and they got it wrong. The previous day in November was 3.2 previous, and now it's 3.4. My data was 3.5, 3.6 November and December, so it was slightly higher, but more or less we are in the decimal point ballpark of the similar level of inflation data. I'm showing you this forecast because when I run the model, of course it will start from the latest data, this December data, and then the forecast will project 6 months, January up to June 2026. So I will share with you my previous work that I performed, iterated in October, to see how does it compare. Now, this one is CPI 12 months, okay, so it's a year-on-year basis, and we are excluding energy, food, alcohol, and tobacco. It's a proxy, or it's a very similar measure of core CPI inflation. So what did I have here? 3.8 in November, 3.6, 3.7 in December, and here we have previous 3.2, 3.2. This core inflation rate and this CPI measure, they are not strictly exactly the same, but they are pretty very, very similar. So my forecast was slightly higher, okay, 3.8 and 3.6, but I see that there is, you can see with me that there is, okay, now it's better, there is a jump, a slight, quite a substantial jump down for January and February headline numbers in the forecast that I got here, which is not the only one. I iterated the models more than once to have a sort of a benchmark comparison or something like that. So here we have that my core CPI still is slightly higher than the data that we have here. Now we go and see what else we got here. Okay, I have another measure core CPI. Okay, and it's way more similar to this one, previous, which is November 3.2, actual, which is December year-on-year 3.2. Here I have core CPI. The forecast, the last data point was exactly October 2025, so I have the forecast starting in November 3.3, December 3.3, so we are roughly bang in line with the actual data that we got from the ONS today. And here we have a slightly upward slope of core CPI in the coming months. It signals to me the autocorrelation of the data. So what does the ARIMA model, what does it looks back at the past data and it projects forward on the basis of time-dependent, time-derivative correlation, what can be the actual forecast, the theoretical data that we will get in the future. And you see here how January is 3.2, then 3.4, 3.49, which is 3.5, and 3.6, almost 3.7. So this, the past forecast that I did in October, it indicated me that there was going to be, in 2026, a slightly upward pressure for upward trend in core CPI, but it's important to understand that this model, it works only the CPI data, so there is no other thing that goes into the equation of the model. So here we have RPI, so the famous RPI. Okay, so here what 4.2 and let's call it 4%. So actually the data that we got here, they are 3.8 was in November and 4.2 in December. I got 4.2 in November and 4 in December, but more or less we are around that level. It's not exactly precise because these are forecasts of the machine, so they cannot, it's acceptable that are not exactly the data, but what we have here that RPI going forward, it could be on a downward trend. Now, when I incorporate in the new forecast the fact that I got 3.8 in November and then goes up in December, probably I will not have the same outcome that I have here of a continuous downward trend in RPI. So now back to my assumption in the beginning of time. Let me squiggle this thing. Okay, as I said, the data that we got today, they are pretty much almost on average level. So if I take the average, the long run average of CPI annual rate from 1989 to 2023, okay, let's exclude this lot which is in now, we see 2.8. Okay, now inflation rate is 3.4, so we are more or less in the ballpark, near or approaching the long run average CPI inflation, annual CPI inflation rate for the UK. So it's important to notice, or not to notice, it's important to observe that the long run average inflation rate is not 2%, it's 2.8. And that it's a challenge, sort of a headache for monetary policy, because I don't know how they can justify that they want to achieve this 2% price stability target when for the past 30 plus year the average CPI inflation rate is 2.8. So if they push hard on containing inflation below the long run average, they will probably run the risk of causing economic damage or constraining economic growth. Okay, so that's why these data, they're not nothing to run home and pop the champagne. But let me take the average, including the people who are in now. So up, down to 2025, up to 2025, 2.8. We are there. It's the same. There is no big drama and say, oh, this lot is better than the other. They are exactly the same. Nothing new under the sun. So if I do the average, okay, let's take the quarterly data. Okay, no, let's take this one. Okay, You'll see that it's exactly the same. Even if we expand the frequency of data, so the number of data points, the data sample that we have, we get 2.83% on average. 1989 up to 2025 is 36 years inflation cycle, and the average run inflation rate for the UK is 2.8%. Okay, so I think it's not reasonable for monetary policy to be so strict in pursuing the 2% inflation target. Not because I want to have the UK running a hot economy, but I don't think the trade-off between containing inflation, I think that the trade-off between forcibly achieve 2% price stability and economic growth, it would eventually create the risk of suppressing economic growth, of constraining potential growth for the sake of achieving 2%. And so it's by that assumption, it's not reasonable anymore to pretend to have the economy into recession for a 2% arbitrary target of price stability. And here I have just implemented on Excel something very simple, which is the standard deviation, which is 2. So what that means is that the average run rate has been 2.8% in the past 30 plus years, but also the volatility, the standard deviation, so how wide is volatile the inflation rate in the UK, it's 2 sigma, it's 2 standard deviation, which means that prices are really have been constantly very much quite volatile. Okay, so there is a lot of variability in retail prices. Okay, so now if I manage to gather, okay, let's see CPIH, which is another very much observed inflation data. We take the old data sample 89 to 25 on a yearly basis. The average run rate of CPIH annually is 2.9%. Now inflation rate is 3.4. We are there. So this data up to the end of 2025, the inflation in the UK, it's deviating, it's above the long, okay, let me do it very quickly. So here we have CPIH, okay, CPIH for the past 36 years, it has been 2.9%, CPI, what was, 2.83%, okay. So the data that we got today, we see that CPI it's 3.4, okay, 3.4. So compared to CPIH and CPI, we are deviating by 0.5. Let's call it 0.6. Okay. Let's get rid of the second decimal to make things easier. So that's why I said the dynamic of the inflation basket for what is the UK economy functioning, we are not so far from the long run average. And that is good or bad. There is no easy answer, because as I said before, the risk is that when either fiscal or monetary policy or a series of conditions, which can be supply chain, global trade friction, trade barriers, tariffs, the cost of raw materials, so the cost of commodities, can be the cost of energy, etc., etc., etc. They are too high, so we have an inflationary risk. But if we we run the risk that if we want to constrain the long run average value to converge to 2%, we can send GDP down into recession, because to basically contain CPI towards this level for monetary policy price stability, at some point we just make a cross on everything and say, okay, now we have to contain, we have to constrain economic growth. So that's the typical, not the cross or whatever, that's the typical trade-off that any policymaker has to deal with at all times. So how far I'm willing to tolerate a slightly higher rate of inflation as long as it's good for economic growth, for GDP. So that's the fine balancing act that the Bank of England or Rachel has to do all the time. So seeing how far I can push taxation and constrain economic growth because I want to have price stability, I want to keep inflation low, and how far I can constrain economic growth. So that's the most difficult thing that policymakers have to deal with, which I'm not going to go into much details now. So let's go forward. We want to find okay, no, that's RPI excluding food. Okay, let's see if we have lately updated the data. Okay, the long run average of RPI, even excluding food, it's 3.8% in the past 37 years. That's RPI housing. Okay, CPI excluding alcohol and tobacco. Okay, so if we want to take this one, which is a proxy of core inflation, CPIH, excluding energy, so all the volatile items, so we want to see core inflation 2.7%. Okay, so we take our table and we start to see what is the if we take core, okay, core, if you do core in the gym, it's a wonderful thing that you can do. 2.7, okay, 2.7%. Okay, now we see core inflation, the data that we got is 3.2, so we are 0.5%, slightly running above the long run average, because if we consider 2%, we would be 1.2% above. So we can see here how for each and every type of inflation basket that I share with you now, we are more or less there. It's half a percentage point above the long run average rate of inflation. Okay, so also to show you that this theoretical 2% inflation target, price stability, all this mambo jumbo of the central bank's monetary policy, I don't know, I'm not sure it's something that it's feasible and achievable in a very static manner, because you see here how the inflation data, they change a lot year on year. Sometimes it's 5, sometimes it's 7, sometimes it's 1.5. So by only in 2010 it was 2%, but it never stays there. 1.6, 2.3. So there is a lot of variability, and that's why it's more of a statement that any central banks can make. So we are committed to price stability, but it will, at least for the UK, but for many other countries, it will never be 2% steady every month all the time. It's actually also mathematically quite impossible to achieve, because I would like not so many things, but another thing. Okay, so if we have 0.2% CPI every month, so in January inflation it's 0.2%, so then in February in CPI it's 0.2%, so it means that prices are growing for the same factor every month, 0.2%. Okay, so if we do 102, I made a mistake, sorry about that, I apologize. So if we do 102 to the power of 12, okay, you will have 2.4%. Okay, so what that means is that the compound effect on 12 periods of a steady zero, I'm sorry about that, there is a zero missing here, 0.2, okay, the compound effect of 0.2 CPI inflation every month will give you a compounded 2.4 inflation rate on a year basis. Okay, so even mathematically it's not easy. Okay, so if I do 1 plus 0.0 0.02, which is equivalent to 0.2%, and I go to the power of 12 minus 1, okay, times 100, 2.43%. Okay, yeah, the compounded effect. So I probably I could be doing this wrong, but it's just a deviation from what I was saying. But the argument is always the same. So it's difficult to have a 2% fixed thing. Okay, so CPIH, we are slightly above 0.5% from the average long run level. So what I'm saying is that it can be an achievement already to have the headline data here 3.4, to have RPI, let's see, RPI decreasing, converging towards their long run inflation average. That will be okay. Let's see this one. This is CPI excluding all the volatile items, so we can use it as a core CPI. So the long run core CPI, which is not core CPIH, core inflation, core CPI 2.5%. And if we compare it here, core inflation rate, okay, core inflation rate 3.2. So here we have more volatility, we have more deviation, because it is not 0.7% difference between the long run average rate and the actual data that we got lately. Okay, so core inflation probably it's still quite sustained. So it means, which is very reasonable for the UK, because having an economy which is skewed a lot towards services, that means the core inflation, services is a big component of core inflation when we exclude energy, food, alcohol, tobacco, etc., etc. Now I want to find RPI, that's personal expenditure, RPI, okay, I can find RPI here. It's way too large, I apologize. Okay, RPI, okay. Okay, RPI, I insert a column here. If I take the average of RPI, yada yada, I'm sure there is a quicker method rather than scrolling down all things, but I don't mind. I'll take the longer method. I'm not using shortcuts, so I'm not really a profi of Excel. Okay, month. Okay, so as I knew already, the long run average RPI is 3.68%. Let's call it RPI. Sorry about that. RPI 3.368%. Okay, the data that we got here is 4.2, so we are 0.52, sorry about that. Okay, so we see here how the actual inflation data in the UK, the broader retail prices, they are more or less half a percentage point or a little bit more in certain measures above the long run average. That's why I said we are not far from the long-term price stability, which is the long run average. Okay, now the long run average is not the long run price stability, because I said before, and you all know that it's this 2% objective. Okay, so as I said, it's not so dramatic. Okay, and nothing. I don't have anything else to add for today, rather than to thank you all for following the channel, and we can try and see what were the forecast a couple of months ago. This is here we have another ARIMA model. Okay, so forecast for CPI, November and December, we have here, you can see 3.69, which is 3.7, 3.6, the lower range bound 3.1, 2.7. Here we have inflation was 3.2, 3.4, so slightly running above, but the following months it will be still around 3%. Okay, so what I will take for my knowledge, what I will take forward for my knowledge is that the long run average is this one. Okay, so I will start to see if the data that we get will run below the long run average, if will be for good or for bad reason. For good reason, it's will be if you have an expansion of aggregate supply and so economic growth goes well and you have a healthy economy and inflation it's healthy, it's not high. For bad reason is that if I will see that inflation data will be below the long-term average, but at the same time you have higher unemployment and sluggish economic growth, that would be for bad reasons. So that's what I will bring forward for my modeling, for my knowledge forward. Okay, so now let's see CPI excluding energy. What was the forecast? Okay, 3.8, 3.67, 2.9. So this is very much similar to the other ARIMA model, and that this CPI excluding energy is the same of core inflation, 3.2, 3.2, and here it's still higher. Okay, but we don't need any education because yes, core CPI and this other data that I have was 3.4, 3.5, okay, 3.3, and it's slightly higher than the 3.2 data that we have here. RPI, what was the forecast? 4.3, 4.4, 4.1, and as we saw here before, RPI was 3.8, 3.8, 4.2. So not exactly the same, but more or less in the range of here the lower range bound was 3.7, here we have 3.8 for November, here we have 4.2, 4.4, more or less we are there. It's not that distant. It can give, because you see here how there is this pink or red shaded area, which is exactly is the confidence interval. So the forecast, it covers a range, a 5% range or a 95% range of possible path that can take the inflation rate data. So here we have, that's the update. As I said, these are the long run average rate of inflation, and we will see now I will update my inflation forecast model. I will add some more data, and I will get back to you all very soon with more content. So please subscribe to the channel, and I will see you to the next episode.